Hello, everyone. This is Catherine Nicholas, and I'll be walking you through my capital budgeting simulation. For this assignment, I acted as the CEO of New Heritage Doll Company and had to choose the best project decisions for the company over the course of 5 years. Um, on average, I chose projects that showed a high NPV, a high IRR percentage, a low payback period, and a higher earnings before taxes at 1 year and at 5 years. We also had to work within the constraints of a budget each year, so that posed a few challenges. I also based a lot of my decisions on what I thought a child would want from a doll manufacturer. So if I go here, you can see the decisions I made over the course of 5 years. In 2009, I decided to expand to the Northeast, and although it was high risk and expensive, it showed that it was profitable right away, which was nice. Um, in 2010, I introduced a doll accessory line, a new doll film, and a tween book series just to get my retail percentage up and start providing more products to my customers. Um, I did the same in 2011 and acquired a children magazine and a video game for the dolls. Um, and then in 2012, oops, um, I also built upon the video game and created a virtual doll community, and I built upon the book club and created that, and also a toddler music CD series. And then in 2013, I created a young authors book series um, and introduced the doll houses with miniature dolls, um, which were all pretty good. Um, Down the line, they'll be more successful, but as of right now, they're not doing too great. I also introduced a coupon promotion, which fell somewhat short of the retail division's revenue targets. But if you look here, I'll show you my numbers. And in 2009, my revenue was at 245, but in the years to come, it increased to 351. My operating income rose from 22 to 40, and my net income increased from 13 to 24. All of these are my actual numbers, and they're exceeding my forecasted numbers, which is something I'm happy about. This brought my total APV to 829, which I'm very happy with. Down here, you can see the division of my revenues. So here in licensing is the lowest revenue, which is expected. It's about 80. And then in production, it's 156. And most importantly, my retail is the highest, and it's at 232. So that is that. Let's go ahead and look at my income statements. So here you can see that my net income slowly increases pretty steadily throughout the years. And these are the current ones here, and then these are the forecasted years to come. So I'm pretty happy with them. It's currently at 24.48 and moves to 27.17, 29, a little dip in 17 goes down to 28, but then a big jump to 30, 32, 34, 37, 40, 43, and then a huge jump to 47. So steadily making more money down the line, which is exactly what I want for my company. Down below, you can see my balance sheet. Here my assets are increasing from 132, 139, 146, 151, 157, going all the way up to 209. Those are my current assets. And then my total net assets are increasing steadily and reaching 349. Down below you can see my liabilities and my stockholders' equity. Liabilities are increasing as well, but that's just due to increased assets and, a growing business is going to have debts here and there, so. But it doesn't look like it's anything too outrageous, and my revenues will be able to cover these expenses down the line. And my stockholders' equity is increasing as well. So that is something that the stockholders will be very happy with. Here we'll go ahead and look at my cash flows. Again, total income and depreciation. My cash flows are increasing, which is definitely something. A tiny dip here in 2017, but then jumping back up to 47, 49, 52, 55, 58, overall just increasing. Here we go. My operations is also increasing. Let's see here, yes. And my ending cash balance is at currently it's at 1052, but it's slowly increasing as well. Pretty slowly in the beginning and then much faster in the years to come. Okay. Now, here, under my financial analysis, we have the debt-free cash flow, which is all totally increasing slowly at first and steadily, and then picks up towards the end in the years to come. Also, when I was working on my simulation, I played around a lot with the discounts, which you can see here in my project details. So if I were to look at the virtual doll community, I kept the project discount at a rate of 7.85, which has a net present value of 5.83, a very high IRR percentage, which was something I looked at. And I also wanted to make sure that the payback periods were lower just so that I can start making my money back faster instead of waiting for the many years to come. So that was a high risk in 2012 project, but it was very successful. We can look at a couple other ones here. For example, the toddler doll accessory line, it was a pretty low risk, but as you can see here, I lowered the project discount rate from 7.85 to 2.85, and that increased my NPV to 164.99. It increased the IRR to 57%, and the payback period is a little bit higher, but overall something that I decided would be good for the company. Let's go ahead and look at another one here. Okay. Here we go. So this is one I wanted to look at as well. The new doll film DVD, I lowered that from 7.85 to 1.85, and it has a higher NPV of 11.14 and a very high IRR percentage of 238.61. The payback period was very small, only a year and about a year and a half until I start making my money back. But something else I wanted to look at was the profitability index. It just kind of shows you want a higher profitability index so that your company will make more money down the line, and just prove to be very profitable. All right, so overall higher net income um, increasing throughout the years, and that is my simulation.